Ladies and gentlemen, good morning and welcome to this Finance Watch conference. It is a real pleasure to welcome today a very diverse group of delegates, which includes representatives of civil society, the European institutions, the financial sector, the real economy, academics, and the press. Such diversity is not only good for democracy, it should also make for an entertaining and lively day of discussions. My name is Christophe Nijdam, and I am the new Secretary General of Finance Watch. Also, my last name is Dutch, I'm French, an externality of the Brussels melting pot, and let's hope that this time it's going to be a positive externality. While I'm definitely a European citizen, I sometimes feel and see myself also as a citizen of the world. Nobody being perfect, I'm a former commercial and investment banker, and I've spent 13 years as a bank executive at some large French institutions, both in France and the US. This previous experience has enabled me to see at close quarters the financialization of the economy and the rising dogma about efficient markets. After that banking experience 20 years ago, I went to the other side of the fence. I moved to the investor side, and I became a stock analyst, most recently working at Alpha Value. Alpha Value is Europe's leading independent equity research firm. My operational experience in bank management and investors' perspectives are keys to my strong convictions of the need to reform the financial sector. In my last role as an equity analyst specializing in banks, I saw that investors who questioned the common view ended up ahead in the long term. I hope that our conference today will pay similar dividends as we do question a number of common views about long-term financing and growth. I would like to introduce today's program by asking you 3 questions. One about securitization, another one about policies for growth, and the last one about collateral. And I will share with you a few thoughts along the way. So the first question: what is this high-quality securitization that we hear so much talk about? The revival of high-quality securitization has been promoted as a cornerstone of the political response. There have been several consultations and definitions put forward, but very little real public debate. That will be the task for the experts on our first panel. Before that, our head of policy analysis, Frédéric Hache, will present Finance Watch's perspective on good securitization. And this afternoon, I'm delighted to welcome Dennis Kelleher, President and CEO of Better Markets, Finance Watch US counterpart, to give us an American perspective on the US securitization market since the crisis. The second question now is about the EU overall approach to diversifying and increasing the supply of finance and credit to the real economy. Is it likely, that's the question, is it likely to achieve its ambitious objectives, and have we considered all the options? One issue is how to channel the growing pile of excess financial capital to where it is needed without creating new dangers. We support the European Commission's view that institutional investors must do more, but only if they use their long-term liabilities to act in a counter-cyclical manner, i.e., to buy when everybody wants to sell, and vice versa. The crisis showed that institutional investors tend to herd together with the rest of the market, amplifying economic cycles. As Andy Haldane of the Bank of England put in a recent speech, patient capital ought to be part of the solution to the long-term financing puzzle. In practice, it may have been part of the problem. Any move to promote the involvement of institutional investors should therefore include clear incentive to act not as short-term traders, but as true buy and hold long-term investors. We must also be wary of shifting too much risk to pension funds and of making our pensioners the new depositors. If tomorrow a pension fund runs into trouble, it is quite likely that politicians would be willing to bail it out. We should therefore pay attention to how much risk pension funds can absorb and be careful not to think that every tool that promotes the role of institutional investor is a silver bullet. In asking if we have considered all options, it is worth noting that several prominent economists and industry figures have cited a lack of aggregate demand as one of the causes of weak growth. Linked to this is the well-documented rise in inequalities as low and middle-class households, many already in debt and sincerely worried about the future, do face a relative decline in their purchasing power. Ahead of the recent Davos Forum, leading economists warned that rising inequality was perhaps the biggest challenge facing industrialized economies. A recent OECD study put it even more clearly. Higher inequality lowers economic growth. Policies that help to limit or reverse inequality may not only make societies less unfair, but also wealthier. Let's face it, the much vaunted trickling wealth effect of inequality did not percolate down into aggregate demand this time around, if it ever did. So it is in the long-term interest of the financial industries itself to recognize this problem, not least to protect its client base. Another factor to consider is that the Commission's long-term financing initiative promotes the investment banking model over traditional banking. As a former investment banker before I became an analyst, I understand very well the positive role that investment banking can play. But we might ask ourselves which bank business models have focused more on lending to the real economy? Traditional relationship lending, especially by small and medium-sized banks, has proven valuable in this area. And our first keynote speaker, Dr. Lothar Blatt von Ratschek, will say more about this in a few minutes. I would add that in relation to investment banking, local relationship banking is also less interconnected, less procyclical, creates less elasticity in our financial system, and leads to less correlated balance sheets between institutions. We therefore believe that promoting traditional relationship banking should also be part of the solution. Possible measures could include removing the inbuilt advantage of the internal model approach over the standardized approach in CRD, because it currently favors large banks over small and medium ones when determining their so-called risk-weighted assets. Other measure, redesigning liquidity ratios in favor of stable funding over liquid assets. Last but not least, addressing the negative externalities of securities financing. I have commented briefly on investment problems, inequalities, and banking models. Martin Wolf, associate editor and chief economics commentator at the Financial Times, has written a book looking at these and other questions in much greater details. I am very pleased that he will be joining us to speak and participate in an extended audience Q&A in the session after lunch. My third question now is about the plumbing of the financial system, as a revival of securitization will create more assets than can be used as collateral. The question, is it really desirable from a stability and sustainability point of view to increase the central role of collateral and securities financing? Collateralized funding can be extremely useful in uncertain times when trust can disappear quickly. But making collateralized funding the new normal is likely to create a more interconnected and more procyclical financial system. When I started in banking over 35 years ago, I was taught by my mentors at the time that a sound lending decision relied upon identifying three sources of repayment in decreasing order. First and foremost, the cash flows generated by the assets itself being financed. We used to call that self-liquidating. Second, by the value of the collateral if the cash flows proved short of expectations. Third, last but least this time, by a creditworthy third-party guarantor if the first two sources of repayment were insufficient. It is worth remembering that the core job and expertise of banks and investors is to lend based on the assessment of the creditworthiness of the borrower, not based on the securities that they can give as a guarantee. And in the case of SME lending, in addition to cash flows as the foremost source of repayment, qualitative factors were to be taken into account in the credit decision, such as intuitu personae trust, based upon a proximity relationship that enables the commercial banker to have his fingers on the living pulse of the SME, i.e. holding its operating bank account. It is also worth remembering that the ubiquitous role of collateral is only a recent phenomenon that can be traced back to the Collateral Directive from 2002. As such, it is not an irreversible fact. As this topic is likely to have strong implications for the architecture of our financial system, and as the negative externalities of securities financing have been clearly demonstrated, we think that it is important to have a debate on it, which will be our second panel of the day. We will then close the day by having the honor of hearing Commissioner Jonathan Hill, who will share the European Commission's view in a keynote speech. We have excellent speakers and panelists here today, whom I would like to thank very much for their participation. I should also add my special gratitude to a speaker who was able, at short notice, to join our second panel on collateral and whose name, therefore, does not appear on the printed program that you have. Kevin McNulty, Chief Executive of the International Securities Lending Association, welcome. I hope that you will find the program stimulating and that you will continue the discussions during the coffee breaks, the lunch breaks, and the cocktail reception that will take place at the end of the day, when I look forward to meeting many of you for the first time. As you can see, the subject that we will be discussed today by those experts are highly technical. And as you may know, technicians are sometimes humorously described as people who make mistakes by abiding by the rules. With regard to experts, one of the insolent definitions is experts are people who know absolutely everything there is to know in their field, while knowing absolutely nothing about the rest. I am an expert. My hidden agenda today is that you won't leave this conference feeling like you have become technical experts. Before we start, a few housekeeping notes. We have a very busy schedule, so please be back to your seats on time. Second housekeeping note, there are members of the press and the whole conference is on record, so be careful about what you're saying. It could end up on YouTube. It will end up on YouTube. Last, there will be Q&A opportunities during the day in most of the session. I will now give the floor to our first keynote speaker, Dr. Lothar Blatt von Ratschek, head of the EU representation from DSGV, i.e. the German Associations of Saving Banks. Dr. Ratschek.
You're right, it's not so good, but I would say it's a little bit the ape situation in the circus. Everybody can see the ape, but the ape cannot see nobody. Okay, good morning, ladies and gentlemen. I would like to thank Finance Watch for inviting me to this conference and giving me the opportunity and pleasure to address such a distinguished audience. Over the last years, our attention has been focused on crisis management, first the bank crisis, then the sovereign crisis. Unfortunately, we cannot yet say that we are out of the woods. The aftermath of both crises is still felt today. But the modest performance of the European economy forces us to look beyond short-term firefighting and to focus on long-term growth, on a growth model that is smart, sustainable, and incentive, and inclusive. In this context, long-term finance has an important role to play. It will contribute to the investment needed to help Europe to exit these problems, as well as to respond to global challenges. To this end, the Commission has published last year the communication on long-term financing of the European economy. Herein, the Commission proposes a number of policy initiatives to increase the availability of funding to the real economy. In this context, the new Commission, for which financing growth is a priority, tabled the Green Paper on building a capital markets union. One has to agree that capital markets funding will have a certain role to play. Large, medium-sized companies find it easy to draw their funding from the capital markets. But the smaller ones are facing difficulties. For them, capital market finance is today too costly, too inconvenient, and too complicated. In its Green Paper on Capital Markets Union, the Commission identifies a number of ideas to tackle these problems. Securitization seems to be one of the most important issues in that context. The pros and the cons of the Commission's proposals will be discussed by the following speakers of today's conference. To avoid duplication, I would like to draw your attention to another topic, the starting point of the discussion about access to finance for SMEs. In the introductory part of the communication on long-term finance, the Commission makes three statements. First, European businesses have been heavily reliant on bank lending. Second, banks' ability to extend credits to companies has been significantly reduced by the financial crisis. The consequences of this are felt particularly by small and medium-sized enterprises, which form the backbone of the European economy. Third, as a consequence, policy efforts are needed to reduce the reliance on bank funding, for example, by improving the capacity of financial markets to fund the real economy. Let us take a closer look on these statements. The first statement, concerning the reliance on SME on bank lending, is certainly true in Europe. When comparing the European economy with the US economy, one can see that in Europe, 3/4 of the SME rely on bank funding and only 1/4 on financial markets. In the States, exactly the opposite is true. The second statement of the Commission refers to the financial crisis and its impact on banks' ability to extend credits to SMEs. The communication analyzes that SMEs suffered the most during the crisis. I quote, "They are still finding it challenging to obtain loans, particularly in the periphery economies, due in part to the fragmentation of the banking sector." This analysis deserves a closer look. Concerning the lack of access to funding, the Commission states that these problems are common in Greece, Spain, and Italy, whereas in the northern member states like Sweden, Denmark, Germany, Austria, the situation is far better, if not to say the problem doesn't exist. First conclusion, the general statement on funding problems for SME in Europe is only partially true. Second remark and question, is this funding problem in the peripheral areas due to fragmentation of the European banking sector? Using the argument of fragmentation in this context addresses financial groups which are active across the borders. They have, in fact, a tendency to withdraw their engagement in difficult times from foreign territories and to concentrate them in their home country. It is logic that this behavior doesn't apply for banks which are active only in one member state. This brings us to the question of who are the banks that finance predominantly SMEs in normal times, and how did they behave during the crisis? At European level, the issue of access to finance for SME is not a new one. It is under scrutiny since the year 2000, long before the crisis. As of this year, the Commission launched a number of surveys and initiatives to analyze and tackle the problem, which was then discussed under the headline of credit crunch. A series of roundtable meetings between banks and SME organizations were organized by the Commission on that issue. I'm sure many of you remember these. By the way, among the topics discussed at that time was also the securitization issue. Also, this is not new. The outcome of these surveys and roundtable discussions was straightforward. The access to finance for SME turned out to be problematic, especially in those peripheral countries which are now named in the communication on long-term finance: Greece, Spain, Italy. In Northern Europe, except the UK, this was hardly a problem. This allows for the following conclusion. The phenomenon of a credit crunch is not directly linked to the financial crisis. But the question remains, why is the situation so different for SMEs in the European member states? In other words, what causes this discrepancy? To find the answer, we have to consider two aspects. First, the soundness and viability of the SMEs which demand for a loan. Second, the business model of the banks to which they turn to for funding. The first aspect is very simple. No one will get a loan from a third party unless he is able to pay it back one day. And it makes no difference whether the third party is a bank, an investor, or even a member of the 3 Fs, you know this: family, friends, and fools. And we do know that, unfortunately, the economies in the peripheral countries have heavy problems due to a lack of competitivity and competitiveness and viability of lots of their businesses. It is clear that this situation has an impact on their access to finance, be it in their country or outside. The SMEs must overcome this lack of competitiveness on their own. Neither bank nor investors can do this job for them. For this reason, we appreciate very much all the initiatives undertaken by the Commission to help those economies to become more competitive. The second aspect refers to the business model of the banks to which the SMEs turn to for funding. It turned out of the surveys conducted in the context of credit crunch that the access for finance for SMEs is far easier in those countries with banks which mainly concentrate on the so-called traditional business model. Traditional business model means collecting savings and channeling them to the businesses. In other words, we are talking about retail banks with stable private and corporate clients and no significant capital market activity. Banks with the main purpose of servicing to the needs of the savers on the one side and the real economy on the other. Of course, also those banks refuse sometimes loans to corporate customers, but they take this decision on the basis of the knowledge of their customers, a long track record, and deep insight into their businesses. This funding selection promotes the growth of good and competitive businesses and disciplines the uncompetitive ones, leading to an overall stronger economy in the long term. It is clear that under these circumstances, the proximity of the bank to the corporate customers matters. This proximity is secured by regional and local banks, around 6,000 cooperative banks, savings banks, and commercial banks in Europe, and by those large banks which have no centralized credit units, but give their local branches the decentralized competence to grant credits, like Handelsbanken in Sweden. The business model of these banks is focused on maintaining lifelong business relations with their customers. For them, sustainable growth of the corporate customer is more important than striking a quick deal. Long-term profitability trumps the short-term cash. That motivates them to stay at their customer's side even during difficult periods for as long as this is economically and financially justifiable. Now you may understand why during the financial crisis these banks didn't withdraw the credits even from those SME customers which have heavily been hit by the decline in demand. At least in Germany, they even increased the loans, giving the SMEs the chance to invest in order to enhance their productivity and to emerge leaner and more competitive once demand came back. In the European Union, we count around 8,000 banks. I guess nearly 6,000 of them are proximity banks and apply mainly this traditional banking model. They have been and they have to remain the backbone of the SME finance. The strong SME segment in the economies in Northern Europe would not be conceivable without a corresponding structure in the banking system. In other words, the banks which focus especially on the needs of SMEs. But the question arises as to whether the continued existence of these banks is assured. There are two reasons for concern. First, the regulatory burden and costs, and second, the low interest policy of the European Central Bank. In its communication on long-term financing, the Commission found very clearly that various regulations may impact a bank's ability to channel funds to the real economy, in particular to the small and medium-sized enterprises. I fully share this concern. The increasingly tight regulatory framework pushes banks to excessive restrictions on maturity transformation. Furthermore, the need for banks to increase retained profits in order to boost regulatory equity leads them to withdraw from long-term lending and less profitable operations such as project or export finance. Finally, the new regulation brings higher administrative costs that makes lending more expensive. Therefore, I welcome very much that the Commission has promised to do its best to find the right balance between improving the resilience of the bank sector on the one side and avoiding excessive restrictions on maturity transformation on the other. And I would add that regulation must follow the proportionality principle more, because the regulation is a one-rule-fits-all and neglects the specific conditions of thousands of European banks which apply the traditional banking model in their regions. To these challenges adds the low interest policy of the European Central Bank. We all know that extremely low interest rates involve substantial collateral damage if they are allowed to persist for too long. This applies particularly to the traditional banks. Why? Because on the one side, this policy discourages the savers by generating a disincentive to the propensity to save. And on the other side, it squeezes the overall net interest margins of the banks and put, since they have no significant capital market activity, their survival into question. So, we live in a paradox. With one hand, central bankers are creating abundant liquidity in order to boost credits. But with the other hand, politicians make bank lending more difficult because of regulation. So let me conclude. First, the ability of the financial system to channel funds to the real economy will be essential in securing Europe's position on a sustainable growth path. Second, it is of course justified to look for alternative sources of finance, but this should not distract us from recognizing the fact SMEs not only need bank lending, but they also need an expansion of bank lending if we want to allow a strong economic recovery. Third, the traditional business model of thousands of regional and local banks in Europe has proved its efficiency to finance SMEs even during the crisis. This model must not be jeopardized. Finally, to promote long-term corporate financing, we do need a coherent strategy which includes capital market players as well as those banks that traditionally focus on the needs of SMEs. Absent such a strategy, the economic recovery of Europe will, as we see today, be compromised. I thank you for your attention, and I will be pleased to participate to the debate today.
Hi, good morning, and thank you for being here today. The topic I would like to discuss is the revival of securitization that is seen as a cornerstone initiative of the forthcoming Capital Markets Union and a key element to revive growth in the European Union. I will present briefly how we look at this issue and what questions deserve a public debate, in our opinion, in order to introduce the forthcoming panel. Even though securitization played a significant role in the onset of the current financial crisis, I believe we all agree that securitization is a useful financial technique that is part of the toolkit to finance the real economy. Securitization offers indeed many benefits. It offers access to a cheap form of funding, it frees up bank regulatory capital, and it enables borrowers to access a wider range of investors. It is also important to recognize that post-crisis securitization is very different from its pre-crisis form. However, since securitization includes a very broad range of structures, the key question really is, what type of securitization do we want to see re-emerge? First, a number of impediments have been identified to a revival of the securitization market. We want to highlight that some of these impediments are positive developments in our view that do not require being addressed, such as the disappearance of the leveraged money investors or the increased share of deposit funding banks that has reduced the need for market-based funding. Several reasons are frequently mentioned to revive securitization in Europe, including facilitating SMEs access to finance, pursuing EU financial integration, boosting European banks' profitability, and increasing institutional investors' role in financing the real economy. Yet, on the first argument that securitization will be beneficial to SME access to finance, some stakeholders that argue that securitization will be too complex to work due to the absence of a unified definition of an SME and due to the differences in bankruptcy laws between member states. They also argue that SME securitization will be too costly for SMEs due to the need to remunerate a number of intermediaries and to provide an attractive return to investors. And therefore, if SME securitization is not viable without subsidies, one might wonder whether it is a sustainable financing alternative for SMEs. Secondly, on the argument that SME loan securitization will address geographical fragmentation in access to finance, we might also want to be cautious. The argument is that securitization will offer SMEs access to a broader range of investors and therefore further pursue EU financial integration, with SME ABS playing the role that sovereign debt played pre-crisis. However, as we've just discussed, harmonizing SME definitions and bankruptcy laws between member states will take years, and until this happens, we will not be able to create pan-European pools of SME loans, which means that SME securitizations are likely to be based on national loan pools. And in turn, this raises the question of whether it is credible to expect that investors will not differentiate in times of stress between SME loan securitization of a troubled member state and SME loan securitization of, say, Germany, just as they did between the sovereign debt of Greece and the sovereign debt of Germany. And to put it in other words, while one of the main purposes of the forthcoming Capital Markets Union is to address intra-EU fragmentation, one might ask the question of whether reviving securitization is likely to address this issue. Lastly, some wonder whether introducing a tight framework for high-quality securitization might create competitiveness concerns vis-à-vis the US. We believe that the strong commercial success of the UCITS framework outside of the European Union is a strong evidence that investors value a sound and tight framework, and that soundness and commercial success go hand in hand. Also, as it has been acknowledged, that investors' negative perceptions of securitization is one of the main impediments to its revival, a tight framework would help restore investors' confidence. Now, coming back to high-quality securitization, while there is a consensus on the fact that this should be part of the funding toolkit, there is no consensus yet on the type of securitization that should be revived and promoted. A lot of work is currently being done to define simple, standard, and transparent securitization that will benefit from a much softer prudential treatment. A first definition was provided at the end of last year within Solvency II Delegated Act. The European Banking Authority also recently put forward another definition, and BCBS IOSCO are currently consulting on another definition. And while these definitions of simple securitization have much in common and share many excellent criteria that we fully support, we believe that one additional criteria would be necessary. In other words, we wonder whether tranching should be part of high-quality securitization. As a reminder, tranching is the practice of issuing against a pool of loans several types of securities with different seniorities. An equity tranche that will first absorb losses on the whole pool, then a mezzanine tranche, etc., up to senior tranches. And while this technique enables to transform BBB loans into AAA securities, it creates a number of concerns. First, tranching creates uncertainty and manufactures complex risks that are very hard to assess. As an example, senior tranches are not risk-free, but are correlated catastrophe risk. Buying them is equivalent to selling hurricane insurance, where you earn a little premium all of the time, but are exposed infrequently to very high losses. However, unlike hurricane insurance, where the risk can be mitigated through diversification, as it is unlikely that major hurricanes will happen in several places at the same time, the risk of senior tranches is correlated, similar to an insurer faced with hurricanes happening the same months in every country where he has sold insurance policies. And this is obviously a much more serious risk. Professor Umbrecht, who will be on the forthcoming panel, could also describe the incredible difficulty of pricing mezzanine tranches. It has also been shown that tranching amplifies the impact of mistakes in the assessment of underlying asset default and correlation. It has also been demonstrated that tranching creates additional procyclicality and conflicts of interest between holders of different tranches. And lastly, tranching attracts less informed investors who are more likely to neglect tail risk and buy assets that they do not understand. Interestingly, a recent BIS paper found that even when securitized assets are simple, transparent, and of high quality, risk assessment will be uncertain due to tranching. So for all these reasons, we therefore believe that tranching should not be part of a high-quality securitization framework. That is not to say that it should be banned, but merely that the additional level of complexity and uncertainty that it creates do not justify a significant softening of its prudential treatment. It is also important to remember that originally securitization was pass-through, that is, only transferring risk to outside investors, but without transforming it. On the flip side, as tranching is what enables to create different risk profiles that match investors' preferences, some fear that real money investors would have no appetite for non-tranche securitization. And this is an important and legitimate question that needs to be addressed. On this point, we believe that, first of all, the purpose of regulation is to provide the right incentive and not necessarily to feed the market current appetites. More importantly, non-tranche securitization would still be able to obtain investment-grade ratings, and provided the risk-adjusted return is attractive, we believe that the market would develop very quickly a strong appetite for these securities. The current environment of very low interest rates and excess financial capital looking desperately for yield should also contribute positively. A few institutional investors we spoke to shared this view, and in this respect, it will be very interesting to hear the opinion of Mr. Patrinishi on the forthcoming panel. Now, once a definition of high-quality securitization is agreed upon, the next question is what to do with it. Or in other words, how much softer should be the prudential treatment of this securitization? A first key question is whether we should maintain the non-neutrality of capital charges or whether we should instead move towards full neutrality as some stakeholders advocate. Non-neutrality refers to the fact that the total capital charge for a securitization is higher than the capital charge for the underlying assets had they not been securitized. And non-neutrality was originally an explicit intention of the regulators to reflect the higher complexity of securitization. So the question is, should securitization have a capital charge similar to underlying non-securitized assets, or should it retain a higher one? Another question that is currently being raised is whether the prudential treatment of high-quality securitization should fully converge towards that of covered bonds. Our view is that while we support a limited softening of the prudential treatment of high-quality securitization, we strongly believe that we should not move towards full neutrality nor to a full convergence towards the prudential treatments of safer assets like Danish covered bonds. The reason for this is that securitization, even high quality, simple, and transparent, will create additional complexity, procyclicality, and interconnectedness that justify maintaining a distinction from a macro-prudential perspective. I will now leave the floor to our excellent panelists who will provide the perspective of different stakeholders on these important topics. Thank you very much.